Today, the boom-bust Megaphone, the DFA daily to the 22nd of July 2021. Hello again, it's Martin North from Digital Finance Analytics, welcome to this post covering finance and property news with a distinctively Australian flavour. In today's show, we look at the latest international market movements as stocks go higher, the US debt limit, who's going to pay for the US infrastructure plans, what the ECB may do, and finally, a read on the local economy as the lockdowns continue. Wall Street stocks posted their second straight daily gain on Wednesday as investors continue to buy the dip following the sharp Monday sell-off. Robust corporate earnings and renewed optimism about the US economy helped to fuel the risk-on rally. This is totally on form given the expanding patterns of higher highs and lower lows. It's hard to know when this might change, or will it simply run for months more, with volatility oscillating as stocks veer one way and then the next. Pricing is currently based on perfection, which are by any means not certain. In fact, I think the indicators continue to build towards a substantial fall ahead, but more of that in a future post. On Wednesday, all three major US stock indices added to their previous session's advance, placing all three within 1% of their all-time closing highs, and economically sensitive small caps, semiconductors and financials outperformed the broader market. The Dow Jones Industrial Average rose 0.83% to 34,798. The S&P 500 gained 0.82% to 4,358, and the Nasdaq Composite added 0.92% to 14,632. It's a seesaw going on between great earnings and a recovering market and concerns over whether the economy is going to slow down because of the COVID-19 Delta variant, said Peter Tuzz, president of Chase Investment Council in Charlottesville, Virginia. But we're seeing strong earnings with generally positive guidance and the feeling that the Delta variant can be managed. A rebound in travel helped fuel United Airlines' revenue beat, boosting its stock by 3.8%, and Boeing was up 2.4% on the day. The S&P 1500 Airlines Index gained 3.3%, while the S&P 1500 Hotels, Restaurants and Leisure Index advanced 2.9%. Earlier in the week, those stocks suffered because of renewed fears that travel will slow down and all related industries will suffer. But those fears have gone away, Toots added. Demand is continuing as expected. I don't think the Delta fear is causing people to change their plans. The benchmark US Treasury yields continued their bounce from 5-month lows following a weak 20-year bond auction, which benefited rate-sensitive banks. The 10-year was up 0.5% to 1.288, and the 30-year was up 0.52% to 1.940. Of the 11 major sectors in the S&P 500, energy stocks were the big winners, jumping 3.5% with the help of surging crude prices, and gold slid to 1,802. Wrangling in Washington over the passage of a bipartisan $1.2 trillion infrastructure package progressed as Senate Democrats moved toward a planned procedural vote, despite Republican appeals for a delay. Second quarter reporting season has shifted into overdrive, with 73 of the companies in the S&P 500 posting results. Of those, 88% have beaten consensus expectations. The solid second quarter results of the 5 US-based global investment banks reflect continued strength in investment banking, higher asset and wealth management revenue, as well as large releases of allowances for credit losses at the universal banks, like JP Morgan. However, there were also revenue pressures from a normalization of fixed income sales and trading revenue, low interest rates, and limited loan growth. Moody's said that aggregate pre-tax profit was a healthy $41.9 billion in the quarter. That's down 18% from the $50.9 billion in the first quarter of 2020, but up from $16.2 billion in the second quarter 2020. Aggregate pre-tax, pre-provision profit was $36.9 billion, and that was down 13% from the quarter one and down 12% from a year ago. All 5 banks maintained healthy balance sheets with strong liquidity and capital ratios that are still up from a year ago, although flat sequentially. The key credit developments for the peer group in the quarter included lower volatility and tighter spreads, which reduced fixed income sales and trading revenue. Equities benefited from growing prime balances and a more orderly market in European dividends than a year ago. Elevated investment banking fees reflect high corporate confidence, strong stock market valuations, low borrowing rates, and an improving economic outlook, while corporate and consumer asset quality continue to improve, and charge-offs are now unlikely to rise until at least 2022. Near pristine asset quality and an improving economic outlook led to a $7.6 billion release of reserves at the 3 universal banks. Goldman Sachs and Morgan Stanley released more modest amounts of $140 million and $17 million respectively, because of smaller loan portfolios and brisker strategic loan growth in target sectors. And net interest income at the universal banks was subdued by flat to declining average loans and low interest rates, though there are early signs of loan growth that could boost second half net interest income. And rising equity markets boosted asset and wealth management results, in many cases to new records, providing solid support for reported results at Goldman Sachs, JP Morgan and Morgan Stanley. But elsewhere on the losing side, Netflix late on Tuesday reported slowing subscriber growth, sending its shares down 3.3%. That's the second largest percentage loser in the S&P 500. And Harley-Davidson's second quarter earnings released showed its turnaround plan appeared to be making progress, but the company lowered its operating income guidance due to tariffs from Europe, its second biggest market, and its stocks dropped 7.2%. Now, in Washington, US lawmakers likely have until October or November to raise or suspend the debt limit, the Congressional Budget Office indicated, offering a wider window of time to address the issue than the Biden administration previously signalled. Without an increase, the Treasury Department's ability to borrow would be exhausted, and it would probably run out of cash sometime in the first quarter of the fiscal year starting October 1, most likely in October or November, the non-partisan CBO said in a report on Wednesday. The debt limit, or the total limit the Treasury can issue to the public and other government agencies, has been on a 2-year hold that expires on July the 31st. The CBO's forecast is later than Treasury Secretary Janet Yellen had previously indicated. She had said the department's tools could be exhausted as soon as this summer, while banks were broadly expecting a deal to avert a crisis as early as the end of September, with an outside risk of a technical default in November. The government's large cash balance could also extend the time the Treasury has to continue financing government operations without issuing debt. The $450 billion cash balance the Treasury projects for the end of July, combined with the department's so-called extraordinary measures, should allow the government to avoid a default until sometime during the fiscal first quarter, the CBO said. The limit, which was last set at $22 trillion in 2019, will adjust to the current level when the suspension ends. It was $28.5 trillion on the 30th of June. And policymakers last suspended the debt limit in 2019 for 2 years, the last episode in a series of brinkmanship going back a decade, with votes to raise the ceiling often going down to the wire. With the new deadline fast approaching, unless Congress agrees to raise or suspend the ceiling again, the Treasury would have to begin special measures to cover expenses. Once those tactics to pay government expenses are exhausted, the US wouldn't be able to meet its debt obligations, a technical default, or would be forced to delay making payments. If the Treasury ran out of cash, the government would be unable to pay its obligations fully, and it would delay making payments for its activities, default on its debt obligations, or both, the CBO said. The Biden administration expects Congress to act in a timely manner to raise or suspend the debt ceiling, White House Press Secretary Jen Psaki told reporters on Wednesday. What's unclear is exactly how or when Congress will act to raise or suspend the limit this time, given the Democrats hold thin majorities in both chambers and most Republicans are unlikely to go along. Democrats may be able to raise the limit on their own, either within or separately from a bigger package later on. And that is all about enacting much of President Joe Biden's $4 trillion economic agenda through a process known as budget reconciliation. But that still faces hurdles, and the timing is uncertain. It's also more difficult this year to forecast the so-called X date, when the government could default, because of the unpredictability of Treasury cash flows relating to COVID-19, according to the Bipartisan Policy Center, which is a think tank. The group has projected that funds will run out by the autumn. The timing and size of revenue collections and outlays over the coming months could differ noticeably from CBO's projections, CBO said on Wednesday. Therefore, the extraordinary measures could be exhausted and the Treasury could run out of cash either earlier or later than CBO projections. One big question in the US is who or what would pay for President Joe Biden's infrastructure spending. A former Biden aide, Evercore ISI analyst Sarah Benici, said it would probably include nearly doubling capital gains taxes on those with income over $1 million. Not that was a state secret particularly. The Biden campaign's website suggested such a move way back. In any case, when this first came out, the stock markets reacted negatively to reports that the White House was considering doubling capital gains taxes on the wealthy to help pay for social spending. The news was particularly jarring to the high-flying cryptocurrency space, with Bitcoin and Ethereum slumping. One question now is whether the closely divided Senate will go for it. Frankly, I suspect that these proposed tax increases will be knocked down at the hand of Senator Joe Manchin, who remains the swing vote in the Senate, said Louis Navellier, the chairman of Navellier and Associates. An alternative is that the Senate could increase the capital gains tax, but by a smaller amount. Analysts at Goldman Sachs suggest they'll settle at 28%, up from 20% currently. Another question is whether the tax will be applied retroactively or not. Analysts at Goldman Sachs in October ran the numbers on the stock market impact of previous capital gains tax hikes. While there's only a modest impact on the stock market as a whole, momentum stocks usually get socked before they're levied, they found. That makes sense. Investors logically are more motivated to sell the stocks where they could save the most by avoiding higher capital gains taxes. The last time capital gains taxes was hiked was in 2013, and there the wealthiest households sold 1% of their equity assets, the Goldman analysts found. According to the Federal Reserve's distributional financial account data, the top 1% held $17.79 trillion of equities and mutual funds in the fourth quarter of 2020. So, a 1% selling of stocks this time will be around $178 billion. The most recent Internal Revenue Service breakdown from 2018 found that millionaires accounted for just over 500,000 filers, or about 0.4% of the total. Now, over in Europe, on the eve of the European Central Bank's monetary policy announcement, the euro dropped to a 3-month low versus the US dollar. Everybody expects the ECB to maintain its dovishness, especially after it tweaked its inflation target, but the relatively minor declines in the euro-US dollar this month suggest that sellers may be exhausted. This poses a risk for anyone anticipating further losses in the euro-US dollar following the ECB announcement. The central bank has given traders plenty of time to price in dovishness, and its decision to set a new inflation target 2 weeks before its policy decision was intended to mitigate volatility when the details are released. All of this suggests that the euro-US dollar could rally on ECB day. But we've seen it before, of course, where central banks are dovish and the currency rallies, or vice versa. So how will the euro-US dollar react to the ECB? Well, it's a function of the market expectations. Going into this week's rate decision, investors expect the central bank to confirm that its change from a below but close to 2% to a symmetric 2% inflation target means it may be more relaxed about consumer price growth above 2%. In June, the CPI dropped to 1.9% from 2% in the Eurozone. And at first glance, it appears that it has put itself near the end of the line of tightening. But if ECB President Christine Lagarde suggests otherwise on Thursday, then the euro-US dollar would soar. While Eurozone data has been mixed, the recovery should be gaining momentum, and many European nations ease restrictions and are welcoming back tourists. Confidence is at its highest level in more than 2 decades, according to the European Commission's Sentiment Index, with economic activity bolstered by reopenings of restaurants, shops and other services. Should the ECB express any degree of optimism, the US dollar could rally on the mere hope that taper is still on the table despite the inflation change. If Lagarde takes this one step further and says the central bank has begun to talk about the possibility of reducing asset purchases, then the euro-US dollar could go vertical to 1.9 or thereabouts. The point is that considering how much the US dollar has fallen, it may not take much for the euro-US dollar to rally when the ECB announces on Thursday. And talking of rallies, Bitcoin extended gains over $32,000, continuing a rebound after raising most of its gains for the year. The latest leg up came in as Elon Musk, Jack Dorsey and Cathie Wood spoke during a panel on the future of Bitcoin. The largest digital currency rose by more than 8% to around 32,270 in New York on Wednesday. Other cryptos advanced too, including Ether and Dogecoin. Musk, the chief executive of Tesla, reiterated his backing of Bitcoin, saying he owns the token along with Dogecoin and Ethereum. He also said Space Exploration Technologies Corp owns Bitcoin too, like Musk's electric car company. The token bounced back after sliding below 30,000 US earlier in the week. That's its first foray there since June. The fear in the market was that if Bitcoin breaks below the $30,000 mark, the price would move lower quite quickly, said Neem Aslam, chief market analyst with Ava Trade Limited. In reality, that is not what we've seen. The Bitcoin price has been stable and we've not seen any panic selling. Bitcoin and other cryptocurrencies have tumbled since mid-May, wiping out some $1.3 trillion off their theoretical market value. And the Bitcoin has faced a range of obstacles, including stepping up regulatory scrutiny in China, Europe, and the US, and concerns about the energy needed by the computers underpinning it. Investors have also generally become more cautious about speculative assets. Bitcoin may still test the $25,000 support level in the coming weeks, said Ava Trades Aslam. A break above $32,000 would herald a stronger recovery, according to Steen Jobson, chief executive officer at Saxo Bank. Bitcoin and Ethereum did manage to pull a rally together after Bitcoin had dropped down through the key $30,000 area yesterday, but really needs to recover above $32,000 sustainably to dig itself out of a hole. he wrote in a note. Bitcoin's advance this year has shrunk to be about 8%, following a slide from an April record of just 65,000 US. That compares with a 15% jump in the S&P 500 index in 2021 to date. Proponents, of course, argue the virtual currency offers an inflation hedge and will win wider institutional acceptance. But such narratives were always controversial, and now even under more question, although Bitcoin's most ardent fans continue to predict big long-term returns. Regulatory and environmental concerns will likely keep Bitcoin heavy, but improvements on both fronts should happen before the end of the year. Edwin Moyer, a senior market analyst for the Americas at Onya, wrote in the note, and he added institutional investors are ready to place big long-term bets if a plunge towards 20,000 US is avoided. The very fact, though, that words from Musk, Dorsey and Wood could swing the market that far tells you all you need to know. And finally today, back in Australia, CBA economist Gareth Aird states the obvious. The level of uncertainty over economic outcomes in the near term has further increased over the past week because of the additional lockdowns around the country, lockdown extensions, and a tightening of restrictions in Greater Sydney. The absence of any downward trend in the number of daily new COVID-19 cases active in the community in Greater Sydney means it is not yet possible to forecast an end date to the lockdown. Income support to businesses and workers negatively impacted by the lockdowns remain critical to ensure a strong economic rebound once restrictions are eased, he says. Last week, they published some preliminary thoughts on the economic impact of the Greater Sydney lockdown. To illustrate the impact of the lockdown in the economy, they ran a simple scenario to say that a 7-week lockdown in its present form would subtract a large 1.4% from the third quarter 21 GDP. And it's worth noting that only 4 days of lockdown were in the second quarter 21. Such an outcome on their figuring would see the national economy contract over the September quarter by around 0.7%. And they stated then that nobody could determine when the lockdown would end because the daily number of new COVID-19 cases had trended up since the lockdown started. And they also noted that there was a risk that restrictions would be further tightened. Since that note, 3 important things have happened. First, the daily number of new COVID-19 cases active in the community has continued to trend up. Restrictions have been further tightened in Greater Sydney, including non-essential retail is required to close and all construction has been paused, which doubles the cost of the lockdown each week. And Victoria and South Australia have entered snap lockdowns. Victoria went into a 5-day lockdown on the 15th of July, which has since been extended a week to the 27th of July, and South Australia went into a 7-day lockdown on the 20th of July. These developments mean that the hit to the third quarter 21 GDP will be a lot larger than the 1.4% they flagged last week. And more importantly, the developments are concerning because things have not moved in the desired direction on the COVID-19 front, particularly in New South Wales. Policymakers stated that the objective behind the lockdowns is to drive daily new COVID-19 cases, which are active in the community, to zero. Once that obstacle has been achieved, major restrictions can be lifted, particularly the initial restrictions imposed in the first 3 weeks of the lockdown in Greater Sydney. The lockdown in Greater Sydney has clearly significantly halted the growth in new COVID-19 cases, but given the daily number of new COVID-19 cases active in the community has not yet come down, it is not possible to forecast when the lockdown will end. Put another way, we need to see the daily number of new COVID-19 cases active in the economy trend down before we can make an assessment of when the lockdown is likely to end. Until that happens, or if that objective shifts, CBA says we cannot discount the scenario where the lockdown continues indefinitely until the proportion of the population vaccinated hits a level that policymakers deem acceptable to reopen the economy. And they concluded in a week's time they will have a much better gauge as to whether or not the stricter lockdown will push the daily number of new COVID-19 cases down in a way that means we can then project the end date of the lockdown. If not, we are likely to be facing a central scenario for the economy that sees the current lockdown in Greater Sydney more a permanent feature until a yet-to-be-determined vaccine threshold has been reached. And in the meantime, income support for businesses and workers remains critical to ensure that the economy has the best chance to rebound very quickly when restrictions are eased. We do not yet have the information to be able to determine what sort of shock we are looking at to income over the third quarter of 21, remembering that household income stepped up in 2020 because fiscal payments were so large as such. So they said we will have to look again at CBA's internal data as a guide as to what is happening on the income side. And that information will be available in the next few weeks. Now, this is an important conversation because what it suggests is that here locally, the economic impacts of the resurgence of the virus will be significant, probably long term, and quite difficult to predict. And then we come back to our broader thesis around the signs of uncertainty ahead. So I'm afraid there are more in the uncertainty bucket than not. And whilst we can, to some extent, look to the global markets to perhaps get a read as to what may happen, we have to more and more understand that we are disconnected somewhat from those global trends because of the current virus outbreaks. Now, if you're buying your home in Sydney's contentious market, you don't need to stand alone. This is the time you need to have Edwin Almeida from Ribbon Property Consultants standing alongside you. Buying a property is both challenging and adversarial. The vendor has a professional on their side. Emotions run high, price discovery and price transparency are hard to find, and then there's the wasted time and financial investments that you make. Edwin understands your needs, so why not engage a licensed professional to stand alongside you? With RPC, you know you have experience, knowledge, and master negotiators looking after your best interests. So shoot Ribbon an email at info@ribbonproperty.com.au, and if you use the promo code DFAWTW/Martin, you can get a 10% discount offer. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.